everybody, welcome. This is we're now calling it Investor Insights. I'm Bonnie Halper. We host these, I write the weekly Startup One Stop newsletter, and we just released the Startup One Stop app. I'll put it in the chat. And we host these every 2 weeks online with one investor or industry expert, I should say, and a small self-selecting group of entrepreneurs so that everybody gets to participate. I want to thank Joseph Katz for hosting us, and then I'll introduce today's guest. So Joseph, you want to tell us about what you do?
Sure thing, Bonnie. Thanks for joining everyone. I'm Joseph Katz. I've been now working with Bonnie, I guess it's 2.5 years.
Yeah.
I have been in the startup ecosystem for a while, and I help startups grow. And glad that you're all here today. And Joe's got some good information to share. I've had many conversations, so looking forward to today.
Yes, Joe Milam is our guest today, and he's going to talk about transparency. What a great time to talk about transparency on both sides of the table. So, Joe, I don't know if you want everybody to introduce themselves first.
Sure. Yeah, sure. Let's keep this friendly. Yeah.
So, Craig, good to see you, and tell us about you.
As soon as I finish chewing, I'm sorry.
Oh, sorry. Do you want me to go to someone else?
Yeah, someone else could go first. Thanks.
Ian.
Hi, everybody. Ian Garmes, based in Toronto. I am the Canadian rep for Virtual Film School, which is launching this week. And we're looking forward to some really interesting new customers.
Congratulations on launching this week.
Nice.
Thanks.
And so are you ready, Craig, or should we have David introduce himself?
No, I'm ready. I guess. Frog in the throat now. Let David go.
Oh, David.
Hi, I'm David in Baltimore, one of two principals in a education startup, new approach to having math students remember the material for multiple years.
So
okay, now I think I'm Hey, I'm Craig Bromberg. I'm the founder of Homesy. Homesy is a social real estate network. It's consumer-powered, user-generated, profile-based perspectives about homes, kind of an alternative to the MLS. We've been working on it for 2 years, and our MVP is ready to go into product, ready to go actually into beta, and we're doing our first real angel raise. We've been bootstrapped over that time.
So, Joe, you have the floor. You want to tell us a little bit about your background? And gee, wonder what the topic's going to be.
Well, we got, is it Null? I'm going to mispronounce that.
Oh, did I miss that? I'm so sorry.
Hi. No worries. My name is Nehal. I'm based in New York City. I am the founder of a cosmetics brand. We are a luxury brand, creating products for people of color. Been working on it for about 3 years now and just launched last July.
How's it going? Congratulations to you.
Thank you. It's been going great. Just been building, but savoring each and every moment.
It's always something to do. So I apologize. And Joe.
No worries.
Joe Milam, Bonnie, and I've known each other for a while. I think I've done a couple of these. Some of you were hearing earlier on, my background is I came from the public markets, the buy side as it's called. And I had a series of serendipitous experiences because after having joined a firm in 1990, right there at 3000 Sand Hill Road in Menlo Park. My boss was part owner of the complex. He was old San Francisco money. He was the pedigreed boutique money manager if you had money. In the 80s and into the 90s, and the bank in Liechtenstein came calling and bought his firm in the late 80s because he was recognized as such, and they wanted a presence in the West Coast in Silicon Valley. So bank bought him in 88. I joined in 90. He died of cancer in 92. I bought it back from the bank in Liechtenstein in 93. Right there, 3000. Internet commercial. The internet commercializes in 94, and all hell breaks loose in angel and venture investing right under my nose. And so a lot of this journey then led to what we're doing now. What I'm involved with now is really informed by that whole journey, because the Band of Angels was founded in my office by Hans Severance, who was my subtenant. And so I was one of the earliest members of the first angel group that sprung forth, and I was involved in some others. And I managed Larry Sonsini's personal money a couple Sequoia partners money, because this, again, it was a boutique industry back then. But after the internet commercialized, it was sort of the beginning of the end of, in my opinion, the venture industry. And then all of a sudden, all of the hotshot MBAs that used to go off to consulting or investment banking, now they want to be VCs because it was the land of easy money. And that was, I saw that happen, that transition literally under my nose. And as an anal retentive student of capitalism and the history of the New York Stock Exchange and the history of the venture industry now, and tracking things through time, you could just see the inevitability of what's effectively now happening is venture 1.0, to be generous, or maybe you call it 2.0 post-internet commercialization, would probably be more accurately venture 2.0, is now popping, and the next iteration is coming. And that's ostensibly what we've been working on with Angelspan and our legacy funds division, 9 years in this iteration. So this is something I've been studying a long time. Enough of the introductions. It's context, because if someone's going to come and project themselves as having something to offer as a speaker or a panelist or what have you, for me, I always want to understand the context of why I should even listen to them. Do they have a level of insight or expertise or experience that I don't have, and I can benefit from hearing their wisdom? That's one of the big problems, in my opinion, and also in this world of startup land, is anybody can be a thought leader. Anybody can project themselves as having experience, wisdom, insights, value to offer somebody else. And it's just nauseating. We're in the South by we're in the middle of South by here in Austin, and the interactive portion is the startup-y portion. And I didn't go to any of it, partially because it started Friday right when Silicon Valley Bank blew up. So there was a real pall over the conversations. But secondarily, the conversations are very superficial. It's just really been the challenge, and to me, the problem of the inefficiencies in how we fund innovation is a result of the fact that it's never been properly professionalized. And the first step of, wait for it, professionalization is transparency, standardized, required transparency. Right now, the SEC is holding hearings to change the Reg D laws to require transparency. If you look at the original Securities Act in 1933, after the 29 crash, they established the SEC to enforce the first standardized transparency requirements for a public company. Audited financials, GAAP accounting, 10Ks, 10Qs, the very things, if you're a public company, you have to report if you want to be public. And if you look at the actual legislation, yes, I have. I read the abstract. It says in an act of risk management, they've established the first standardized transparency requirements, reporting requirements. And then this Investment Company Act of 1940, in an act of further risk management, defined the required portfolio management practices if you're going to manage a large portfolio for fractional owners. Think of a mutual fund. It's called a 40 Act product. ETFs are called 40 Act products because they're structured and managed under the regulatory requirements of the Investment Company Act of 1940. Well, again, if you look, the common theme is standardized reporting, standardized professional practices, either on the company's part in the form of standardized reporting or in the 40 Act investors' part. Well, that level of professionalization is all I call that, has never entered the entrepreneurial world. And it's now getting, and it's going to in an accelerated fashion, even before SVB blew up, largely in part because of the FTX and the attention the FTX blow up caused. The SEC, Gary Gensler's been grumbling about some of this stuff since he came on board, but FTX has accelerated his activity. He's ahead of the SEC. They're holding hearings again to change the Reg D laws to require transparency, which will establish standardized reporting requirements in some capacity. But why? It is an act of risk management. And the counter argument is, if you don't have standardized reporting requirements in place, or at least as a de minimis expectation from investors, an expectation that you're not going to get my money unless I can see some proper professionalism in your reporting, your corporate governance, your back office, how you're actually operating your business, not just what the idea is. Then it allows for the Elizabeth Holmes of the world, or the SBFs of the world to fool people. Just because somebody has a lot of money does not mean they can be fooled, and they're not operating in their limbic brain to chase a shiny object because everybody's doing it and they have a fear of missing out. And it seems to be a lot of activity and fun over there. Those people seem to be the cool kids. This is all the manipulation of the limbic brain, and it's down to a science. And that's the demo day model. And yes, Bonnie, I'm sorry. Oh, you're muted. You're muted, Bon.
You know, when there, before the bad blood article came out in the Wall Street Journal, a friend of mine was going to invest in Theranos. He was in New York when we were talking about it, and blah, blah, blah. And I knew who was on the board. And I said, you know, and I happen to have a background working in research labs. And I said, you know, and I said, don't do it. It's not possible. Then he said, did you see who's on their board? I said, yeah, nobody with a background in research or medicine. I mean,
Right.
this was the same thing with Silicon Valley. Doesn't anybody look at who's on the board? Is that not important?
I was reading annual reports and quarterly reports in college. I'm a finance nerd. I mean, I really am a finance nerd. And I remember, and it's so revealing when you read, and I would start with the board of directors because the tone comes from that. You can absolutely tell the DNA and the culture of the business when you look at their board of directors. I would always start there. In a similar tone, if you listen to some of Buffett's wisdoms, he always starts with the balance sheet and he looks at the board of directors because that's the organization and the assets. The human capital is defined by and the culture set by the board, the tone, who gets on the board. But then the balance sheet is the assets that's going to be deployed to create the revenue and the metrics that are captured in the income statement. So you literally start from the back. The balance sheet comes after the income statement in an annual report. So you literally, the best way to read a quarterly or annual report is from the back. You don't start with the fluff in front. You go start from the back and work forward because it gives you context. I mean, this is, anyway. So, but transparency itself is when you just look at a proper system design, the optimized system design using a design thinking approach is you start from transparency. When there is an absence of it, that is a ecosystem, and again, I'm not talking outside of entrepreneurship, that is ripe for both fraud and will not end well. It happens every time. So what does that mean for startup land? Well, the good news is those entrepreneurs that are either already transparent or embrace it, you get to elevate yourself to be the adults in the room. It's not hard. It's like being the tallest person in a room full of midgets. You know, how many entrepreneurs are panicking right now because when's the next demo day? I've got to be able to pitch. Well, that's a really silly way to raise money, but they've also been trained and wedded on that pitch process as the sole way to communicate what's going on and the investment worthiness of the business. It's not the only thing. It has a role, but it's more about the sizzle, but you've got to be worthy of actual transactions. Yes, Bonnie.
I just wanted to comment that from what we've seen, even since the Web 1.0 days, investors don't seem to put much stock in adults. All well and good what you're saying, but I mean, let's be real here.
Well, I think that that's an accurate reflection of the typical participants in startup investing, but they themselves are largely not adults themselves. That's why. The serious money dabbles around the edges in the legitimate venture funds, but the allocation to the asset class, when you look at the serious money, is very small. So yes, I agree with you, but that's like saying the power law is an ironclad law of the venture asset class. No, it's not. It's an accurate reflection of the necessity for the old venture fund model in its flawed architecture. It needs a home run because they're so bad and they strike out so much. So it's an accurate assessment of an old and flawed model, but it's not a law of nature of investing in startups if you did it right, if you manage risk better through proper diversification. Don't just chase shiny objects, right? Actually do and require some degree of transparency to do at least a modicum of analysis, of risk management analysis. That's not brain surgery. That's not a major hurdle for investors to have to do. And the requirement for entrepreneurs to communicate to attract a less than FOMO driven investor a modicum amount of transparency is not a heavy lift for them either. It actually is just adult behavior. And that's the point. There's some great research on this that came out of University of Leeds. Happy to share any and all this research I've got, but be careful what you ask for. But it showed this very fact. There's been a lot of anecdotal reports done and studies done, but this was the most rigorous statistical analysis using a whole lot of venture data with a bunch of grad students and deep statistical analysis and blah, blah, blah. And it simply showed that those startups that were run by CEOs that were properly and voluntarily transparent dominated the pile of successful startups. And conversely, those that weren't properly and involuntarily transparent, really key words, voluntary and proper, dominates the pile of failed ones, regardless of size of market, who's on the cap table, how much money they raised, the glamours, CVs of the founders, blah, blah, blah. The traditional due diligence optics.
Now, Ian posted a question in the chat. I don't know if you want to.
Oh, yeah. I'll shut up and open this wide up. I'm just kind of lecturing now.
I told people, Ian, do you want to ask your question? I know you're not.
Yeah, I take what you're saying, Jill. I mean, but there does seem to be in the startup finance world a lot of magic and alchemy, where things develop certain interesting technical characteristics and they suddenly become unbelievably valuable. So, like WhatsApp is an example, like something that was created, it became popular, was not financially, very successful, and yet suddenly gets acquired for a vast amount and turns into a very successful operation. So how does your model sort of take something like that into account?
It's easy. Facebook saw the balance sheet assets called the IP and they bought it. Those are balance sheet assets. The technology was a balance sheet asset. And they bought it. It's completely
but to evaluate that requires a kind of almost intuition. Like they couldn't immediately see that it would become $1 billion operation.
No, of course not. Nobody can predict the future.
So there is some.
So what's the question though?
Because you're basically saying that the only important thing is transparency. So do you think that WhatsApp exhibited that?
Wait, I didn't say the only thing that's important.
Well, an important
I said it's a starting point.
Okay.
It's a starting point. It's a starting point.
So if they don't have that, then they shouldn't be taken seriously if they do not have transparency.
Again, you can cite all the one-off examples you want, right? There's always exceptions. There's always, especially when you've got a Facebook that's going through what it's going through. If truth be told, they had no idea it was going to become as big as it did because the social media trends became what they became, right? And then you got the TikToks and all the other stuff. So again, taking something as simple as that in maybe once in a generational technological, sociological shift and say, how do you account for that is just not how portfolio managers think. And this whole thing is, and this logic is about how to deploy capital in innovative companies and get a good rate of return and how to manage risk. And for serious entrepreneurs, how to be a serious entrepreneur. These were tech nerds that had connections to the tech nerds at Facebook, and the tech nerds at Facebook bought their buddy's company.
Right.
Those are such one-off scenarios. That's not how a system designed needs to account for, or best practices needs to be defined by or even influenced by. So this is all about probabilistic outcomes of optimization. Same thing, just because you're a publicly traded company that's got audited financials, hell, look at Silicon Valley Bank. There's one of the big things that's going to come out is how bad their auditor did. And these are audited financials. So you can't protect against bad behavior, but that also goes back from when you're investing in startups and investing in anything, diversification is critical. Don't spend too much time with any one thing because A, you get captured, and B, you can't predict the future and you can't insulate against fraud or just bad actors at multiple levels. Yes, Bonnie.
No, I was going to say, unless you have more to add, I wouldn't exactly call Mark Zuckerberg and Jan Kuhn big buddies. And Craig Brownberg posted in the chat. Craig, do you want to?
Sure. So just if we could turn away from the public markets for a second, I think from an angel context and a startup context, I think one of the really challenging things, of course, for any entrepreneur is to actually work on the hardcore financials and the unit economics of their company. I know we have. Our product has been in development for 2 years, and while we've been doing that, we've been, working on a significant amount of capability hang on, this is a kid who's trying to get my attention. We've been, really focusing fundamentally on what do those unit economics look like. But, in fact, just yesterday, I think I saw Harry Stebbings, who's a very hot young, founder.
I
Sorry.
see his stuff. Yeah.
Yeah. Say, whatever you do, no matter how good your sheets are, they're trash. They're fancy.
They are. They largely are. Yeah.
And so, I think we're in a double bind here, which is fundamentally that we're required to come up with, and required, self-required, right, as much as market required, to come up with a significant mature perspective about the viability of our companies in markets. Those are projections, they're forward-looking.
Mhm.
They're not based on reality fundamentally. No matter how much research is underneath them. And we've done a lot of research to quantify all kinds of components in our model.
Yeah.
So we're left then with this very ambiguous environment where, hey, on the one hand, our financial capabilities are, let's say, not trusted at the very best. And on the other hand, required to show, as you said, transparency in terms of our operating model, how we understand the characteristics of our unit economics, and how those actually work operationally. So, I'm curious to hear your perspective about how we, as startups, and I've looked a little bit at the Angelspan site, and so I think it's interesting, and I'm very much in tune with what you're saying about having a transparent relationship to this stuff. How much is
What's your question here? Let's get to a question.
I think there's a wide gap between the reality of the interests of transparency and the realities of how the investor community looks at startup finance. And
So
that gap is
the question is,
what's the right way to go?
There we go. Let's get there. Because everything you said, I completely agree with. Okay. And again, but understand, I have a belief system that I've yet to have it really violated. My mind kind of thinks in the scientific method. And my hypothesis or thesis is that 98% of the venture capitalists out there, and forget the angels out there, don't know what they're doing in investing money. And that's why they default to, I won't lead, but I will follow, which is about 80% of the venture funds out there, right? That's their direct admission. They don't know what they're doing. And that's the problem that entrepreneurs face in pitching or providing what they think is proper transparency when it's an audience that doesn't know what they're even looking for. So they will oftentimes, I've seen this firsthand, throw up arbitrary new KPIs to avoid being accountable for the fact that they don't even know what they're looking for. Now, that's on the investor side. Now let's go back to what does it look like? How can you control this and optimize on it? One is, 5-year projections are useless. Okay. About 18 months is really what you want to spend the time on. That's fine. And yes, it comes down to the unit economics. And to me, if I was looking at somebody's financials, I would want to hear how they did their calculation of their unit economics. How'd you get there? What was the research you did to get there? That's really what I'm trying to discover here, not the actual math itself. Does it make sense? But mostly, how'd you get there? Because that's both a reflection on your thoughtfulness and also the logic, because there's got to be a presumption that you're more of an expert in this field than the investor. You've done more homework and more granular research. So just being able to reflect that. Now, the problem most entrepreneurs don't realize is a pitch deck or a fancy financial model, however rigorously researched for 18 months, lots of tabs with all the maps to all your research that rolls right. And then you get to really a thoughtful calculation on your unit economics for an 18-month rigorous financial model. It's useless because it's a snapshot in time. And that's what proper transparency means, a sequence. You have to have a cadence of communication. It's not just really transparent and available in a data vault. Okay,
so
that's what
I'm sorry to interrupt. And so how does Angelspan create the regularity of transmission and communication that are required to?
That's what we built for 9 years. And I'm not here to pitch Angelspan. I'm certainly happy to explain it, but I'm not here to pitch it, honest to God. It really is.
I'm not looking for a pitch, but I am interested in hearing what
Yeah,
it is.
well, we built a platform to extract. We've got IP that structures it, so we know what's the right things to be looking for. It's called the Bell Mason Diagnostic. We talked about this on one of the prior things Bonnie hosted me at. Most entrepreneurs don't know what the right KPIs are, and certainly most investors don't. Well, this was scientifically built, and also partially built by Coopers and Lybrand to create a gap-like reporting structure. What's relevant to report on for startups? Going back to the earliest stages of the startup lifecycle. Yes, pre-revenue. The common fallacy is, oh, I don't have anything to report because I don't have any revenue. Well, that's a really silly comment. It's a very naive and uninformed comment. And more times than not, it's a rationalization of, well, I don't have anything to report, so that's why I'm not transparent. No, it's wrong. When you're building the business, you're largely building balance sheet assets early on. You're building IP, you're building marketplace knowledge, market presence, maybe trademarking, you're paying lawyers. Hell, if you're building software, you're paying developers to build software. And even under GAAP accounting, you're expensing it as an R&D expense. It never shows up on your balance sheet. It just shows up as a line item expense, as an R&D expense when you're building software, which is your principal asset you're going to go monetize. So even GAAP accounting is not sufficient, but the Bell Mason, it represents the closest thing to GAAP reporting for the early stages to capture. Well, we license the Bell Mason, we score the clients against the Bell Mason every month, but we built a platform. We put a client on every startup. So one of our internal people works directly with, it's like you're outsourcing this service to us. It's not a SaaS do-it-yourself dashboard. We've got a platform. We make it easy to extract the relevant activities throughout the month. We curate it to relevancy based on the Bell Mason. And then we curate and write it for you, produce it through our platform, and then it gets kicked out. We've got a rhythm of getting what's relevant to produce and maintain a proper cadence of communication, because one of the sayings I've heard, which I agree with, is investors invest in lines, not dots, lines of information, a motion picture, not just a deep dive on a fancy financial model and lots of this and a really fancy pitch deck and a really good exec summary. That's a snapshot in time. Okay, our work actually, by tracking against the Bell Mason, I can show how well our clients are executing against it. We've created the first objective, standardized, longitudinal performance analysis. I can show you my best clients, startups, based on data, and have no opinion on what they're doing. Size of market and all that other stuff. I don't want to know. I want the data, and we have it. So yes, there is a way to do it. We built it. I can tell you we've got lots of recognition as we're best in class. Again, it's because we're the only ones that built it right, that started from a design thinking and modeled it after best practices in the public markets, which is where I had a lot of experience in the past. And yes, now the SEC is moving this direction to require some form of it, because the commitment to transparency is a critical mindset. But the cadence is what scares off the bullshitters. Anybody can focus long enough to put out a nice deck and a nice this and a nice that, and then they take the money and they go back to, oh, they're so exhausted raising the money, and they go back to spending money and they overlook this process. And it's just a classic mistake. We solve that in this professional tech-enabled professional service to make sure the cadence communication, which is the most important for the first 6 months, is the cadence. The science behind, because one of the big questions is, oh my gosh, what do I put in there? I don't have a big enough analysis. I don't have big enough milestone traction points to put in there, which is a false concern, by the way. The science is called impressions management under signaling theory. Happy to send the research. But the fact is that if you get somebody to open something like this, if it's a stakeholder, potential investor, or even an existing investor, you got their attention span. This research is 9 years old, by the way. So I think this is it's even worse. But back then, you had their attention span for 3 minutes and 26 seconds. And they're going to remember about 20% of what they read. And you can't guarantee how much they read of whatever you sent them. But they're going to remember about 20% for 5 minutes. So anguishing over the content is a false concern. Waiting till you have big announcements is a PR motivation, not an investor relations best practice.
Fair enough.
What lingers is the professionalism, the image that, wait a second, these guys are adults. These folks are serious folks. I've not seen a startup do this before. And each monthly update reminds them of the professionalism. This is not a one-hot newsletter just around a funding event. Now you make it easier for them to believe in you as an entrepreneur. And now they can sort of free up their limbic brain to start getting interested in what you're doing because they have more confidence in how you're doing it. And that's the psychology.
There seems like there's plenty of value in that. I don't see anything on your website at all that mentions fees or pricing or anything like that.
Yeah, I'm happy to send information. We don't do, because again, we just found from a sales cycle standpoint, this is an adult behavior. We've got 3 levels of service. If you haven't raised any stranger money, forget the arbitrary label of seed, seed or pre-seed. Then you need our basic package, which is called seed, and that's $250 a month. That's month to month. So this is like a retainer. And we're going to come in there and get your act in order and make sure you do it for $250 a month, month to month. And then once you raise a decent round, $500,000 or more, right? Not just a kind of post-seed pre-A. I mean, people are thin slicing some of these silly labels. Then you step up because you need the quarterly report. You need the other stuff to report to those investors you just attracted. And that's $400 a month. And then if you start approaching a B round and have a couple serious people on your board, you've got a serious board meetings, then we've got another one for that level where it's got board package structure around the Bell Mason, stuff like that. That's part of the service. And that's $600 a month. That's it. But all the time we give, all the coaching, all the hand holding, all the nudging, there's layers upon layer upon layer of additional service. We do intend to, and our aspirations are to be the industry standard. And so we deliver a lot more value for the money than some SaaS do-it-yourself. It's like using QuickBooks and saying I'm got audited financials. Well, that means nothing. It's a tool to do it yourself, keep your books if that's what you're doing. Our competitors out there, if there is such a thing, they're all just build do-it-yourself SaaS templates that are largely SaaS business models and SaaS business model KPIs. But they're all do-it-yourself tools to call yourself you're reporting properly, which is better than not doing it, but it's only marginally better. It doesn't create standardization. There's no Bell Mason rigor to it. And you only can have one standard reporting format. Otherwise, it's still noise. So yeah, we deliver a ton of value for a fraction of what we could charge. But that's not the point. We want entrepreneurs to get it done right. Because there's going to come a time when if you're not, in a perfect world, not using Angelspan, Gordon Bell saw this. He literally said this. He said, Angelspan will become the good housekeeping seal of approval. And investors will say, why aren't you using Angelspan? It becomes the first due diligence question. And that will help everybody involved. Yes, it's advantageous for our business model. But this is just basic theory on you only have one standard. And we had to work hard to earn the right to be that standard. And we built that business to be able to. And we've been recognized as best in class. But yeah, there needs to be standardized transparency, and entrepreneurs that make excuses not to be transparent are self-admitting they're not investable. But we spend a lot of time training investors to look for these signals and not just chase shiny objects, not be susceptible to the shiny object syndrome, because they can be their own worst enemy. And once we start getting more adults in the investor network, this just becomes de facto standard. And that's where it's going. And the SEC is changing the Reg D laws to help nudge both sides of the party get there. Because that's just basic professional behavior. And that should be the entry price for both investors to claim they know how to manage a venture fund, but also for entrepreneurs to be worthy, is to say, look, you understand corporate governance? This is best practices. It's clear. Yes, it's now required, but doing it because you have to. Remember, that word voluntary was really insightful on that research that came out of the University of Leeds. The voluntary gesture is a powerful commentary on the jockey, on the CEO. Is he or her? I had a call yesterday with a referral. We got a partnership that's taken shape quickly with the WeFunder. They seem to sort of risen to the top as one of the top crowdfunding platforms. And we've got some clients that we raised money on WeFunder, and now they saw Angelspan supporting function. And now we have a formal partnership. And so I had the first conversation with one of their clients as a referral. Well, this gal she was a CEO of a public company. She's an adult. She got this right away. Of course, I've been doing it, but it takes so much time. I said, exactly. We saved you a ton of time, and your time has value. That's for a serial entrepreneur, time is the most valuable commodity here. They understand how important this is. And she got it in a heartbeat. The curation and the hand-holding, the fact that she can delegate the responsibility of submitting content to her direct reports, which is how we coach the entrepreneurs. This all shouldn't run through the CEO. It's not the highest and best use of your time, for crying out loud. It's your responsibility to get it done right, but it's not the highest and best of your time to produce it. She got that like that. And she stepped up. She's now at the 600 line. Okay, because yeah, we're on our way to a B round. Or a Series A. I mean, I know the thin slicing. But point being is that best practices were figured out through trial and error oftentimes, isn't necessarily a regulatory construct. And it's easy to learn what to do and what not to do just by studying best practices or bad behavior. Just do more of that and don't do that. Don't think that the power of your idea or the sexiness of your marketing package or your videos that you're, you know, the glamour stuff makes you investment worthy. Those are all important components. Don't get me wrong. I'm not saying you don't do that stuff. It's just not where you stop from an investor relations / fundraising strategy and then post fundraising investor relations.
Well, if I might put just a slight, you know, I think the other perspective is that you can give us all the finance you want, but the reality is all people want to see is quote unquote traction, right? They want to see users flowing through a platform. They want to see the ability of you to actually create a capability to do that with, you know, with either product-led marketing or hustle. I mean, there's a whole fund called the Hustle Fund, as I'm sure you know. And it's just focused on this very idea is how far can you get hell with numbers? And so I think, you know, these are the polar opposites in some respects. They define the degree of transparency around the market. It's like, you know, I don't care about the financial component as long as you're obvious.
Well, transparency in the reporting, if you look at the Bell Mason, at least in our contract, the financial side is just one component to it. And you don't need to report financially to anybody, including your investors. You don't need to report monthly. That's a quarterly reporting function, the financials, the numbers. So the Bell Mason covers the team, the product itself, the market, which includes marketing and sales activity. And then operations is accounting, legal, and funding. So there's plenty of topics to report on that has nothing to do with financial reporting. And it's exactly to your point. Yes, where's traction? But traction can't just be in one area, building the product. It also can't just get out there and be selling like crazy and you're selling vaporware, right? This product market fit milestone issue. But you also got to have a sound foundation so you don't want success to bury you, grow too fast. A la Silicon Valley Bank. Okay, so, and that's the literally scientific construct of the Bell Mason is, in a perfect world, it's like building a building. You don't build one side of the building first, and then I'm going to do the other side of the building. No, you build it from the foundation up. So everything is built on a sound foundation. And in building a building, it's plumbing and electrical and infrastructure, right? And carpentry work. Well, team, product, market, and operations. This is the infrastructure of a business. And you just don't do product and market. You got to have operations and team in place, right? And you don't just build a great team and get overstaffed with a bunch of rock stars and no one's out selling or no one's building a product, right? It is literally, and that's the whole point. So you're absolutely right. How do you communicate traction that's not measurable? Well, that's what the Bell Mason does, is allows us to put a numerical value to a qualitative but value creating milestone. That's why they built it. Because so much of that early traction is soft stuff, right?
Absolutely.
But relevant.
Oh, Joseph had his hand up before. I know you had a question.
I'm sorry. Yeah, you guys stop me anytime I get on a roll here. Please throw something at me. And Bonnie, somebody says just shut up, Joe. I got a question. So
Shut up, Joe. No.
There we go. Thank you. Please.
Yeah, I've spoken to you about this in the past. I'm just curious, you know, obviously the price point shouldn't be holding anyone back from taking advantage of these types of services. What, in your opinion, is the reason why many companies, whether it's on the funding side or the entrepreneur side, are not requiring or using these kinds of services?
Well,
especially in today's, especially given the world that we're living in right now.
I think, well, again, as I was trying to paint that picture, this is the you know, whether it's venture 2.0 or 3.0, whatever the next phase is not going to be the case. The pushback, looking backwards, and again, it really depends on how far back we looked. This is Angelspan's been around 9 years. Okay, early on, it was like, yeah, great idea. Then once we had use cases. We literally had unbelievable use cases early. We took that to family offices, VCs, and angel groups. And I got a reaction I didn't expect. They actually like to complain about no information, but once you showed it to them, kind of scared them because they didn't know what to do with it. So there's a lot of lip service to wanting more information. But I think that's just almost a cover story. I really do. Given the experience. Now, again, I'm looking backwards. This has gotten better and better and better. We've been pushing out a lot of this research. If you just incorporated a transparency filter as your first question, whether you're especially family offices are very sensitive to their family brand and not saying no. They don't like to not say no, but they want a way to deflect as well, or at least filter to some degree. If it's a small time VC, the localized VC, they like to be entrepreneur friendly. So they don't like to place expectations on entrepreneurs, which blows my mind. Wait, you're going to think about giving them money, but you don't want to place an expectation on them? And that's not your money, by the way, it's your LP's money. Where's your fiduciary duty here to your investors? So there's a lot of rationalizations at the startup level. From the investor side, it's, again, the obfuscation actually serves them well because they can make excuses. We don't get enough information is a cover story when things blow up and don't work out. That's my cynical view, but it's pretty damned accurate. From an entrepreneur side, they've never had this expectation. The Pitch Fest industrial complex trained them to be entitled entrepreneurs and big splashy things and. Now I'm being heavy-handed and cynical, all right? But it's not a natural behavior for anybody to be transparent and accountable. And that's really what transparency imposes, is a level of accountability that adults don't like accountability in certain areas, right? So this is a human reaction. The typical 3 questions is for the younger entrepreneur. We had a little graphic on this. The more seasoned, the time was the greatest value proposition. We're giving them valuable time back, both mental focus time, but also clock time. That's the biggest value proposition for a serial entrepreneur that would sign up with 1 phone call. You guys do the heavy lifting and I can outsource this to you. I say, yeah, we're the bad cops. We'll go to your head of product, head of HR, your head of operations and nag them, curate it, and then the CEO gets to just finalize it, put their final touches and approve it, and it gets kicked out monthly, right? So, but a control freak CEO, first-time CEO that doesn't know what and they're trying to put their voice in it. That's a massive tell. So to answer your question, it always came down to who the audience was, either of investors, why didn't they require it? Or they had their own secret sauce. They don't want to actually have some reported standardized reporting. They extract their special sexy data.
It's funny. You almost fell into my trap there because the question was a little bit loaded because of the first time CEO control freak thing. I've experienced that many times. It's exactly, those are the people that need it more than anyone else.
And they don't know what they don't know. Yeah, and that's where what we learned. And we had tons of use cases. It accelerated funding. Investors, our first written up use case was a startup that it was about parking technology, managing parking lots better to extract more cash flow and better security. They were here in Austin. They had $1.2 million in revenue. They'd already raised a bunch of money. The CFO, they had a contract CFO. He recommended us to the president. He kept finding excuses. Too busy, or I'm prepared. Wow, all the excuses I've heard in the world. And in the process, there's a family office that had been fairly active here in Austin in investing, and he had pitched them for some time. I knew that group called Wild Basin, to be honest with you. Well, finally, the CFO banged the CEO over the head. He used us. First update went out. Wild Basin wrote a check and literally said it's because you're using Angelspan. Because they were already familiar. That's what we're doing, is educating investors on the importance of having this expectation. And they said, oh my God, you should have got investment banking. I said, I don't need a commission. I want to do the write-up. This is a use case, but this is typical, right? They're not members of the angel groups, right? The angel groups are social clubs. Entrepreneurs pitching angel groups largely are pitching a social club. I've been part of and studied the phenomenon. I've spoken at Angel Capital Association annual events. It's largely social clubs for retirees. Caution, caution, caution of your own expectations of what you might get. Yes, they want to have the pitch. They want the shiny object. They do not care about the numbers. They'll claim they care, but they really do. They like to know they're there. And this is a really, really important point as well for those entrepreneurs pitching. Daniel Kahneman, many of you may have heard of the Moneyball movie, book, phenomenon, behavioral economics or behavioral finance. He's the patron saint and the sort of the father of that. Although there's people that did studies earlier, he's the sort of the rock star on it. He won the Nobel Prize in economics as a psychologist in 2002 for something called prospect theory. And it's really important to keep in mind. The prospects for loss are twice as impactful on people's decision-making than the prospects for gain. That's the simple summary of prospect theory. So when somebody's looking to invest in a startup, the prospects for loss are twice as impactful on their motivation than the prospects for gain. Really important. Don't sell the sizzle. You've got to attract their attention. You've got to get their attention. They got to like or care about what you're doing or who you are or where you're doing it, the sort of impact criteria, without a doubt. I'm not saying the limbic brain is not important. It's how you get their attention. But once you get their attention, the balancing act of communications, both in your investor relations and your pitch decks and your phone calls and your in-person meetings, that's a total process, is this balancing act between keeping their limbic attention while also de-risking the transaction. That is the optimal model. De-risking the transaction while keeping their limbic attention. That's the science that goes into, and my team is trained on this. That's how we built this, to help our clients navigate that balancing act. And if you're a deep tech solution, we try and find reasons for them to give a rat's rear into what you're doing besides just the potential financial upside. Back to your WhatsApp thing earlier. If you're overly impact flavored, we want to lean into the legitimacy of the business. Don't keep selling the heartstrings. You've got to de-risk this and act more like a business person than a nonprofit if you're an impact startup. So that's, again, layers of some of what we're doing, but I just put that forth because there is a science to this. There's a better way to invest and a better way to communicate to investors. And what we define better is based on a tremendous amount of research, depending on which audience. Our legacy funds division is for the investors, how to invest better. And that's been well researched, and I've had published white papers in prestigious journals, blah, blah, blah. But from the IR side, from the entrepreneur, there is a better way to do it. It's not this or that. It's a strategy that incorporates all that. And you also do need to understand who you're pitching. Do they know what they're talking about? Is it old money? Is it first generation wealth? Is it hot money? Is it just FOMO money? I mean, you need to understand who you're pitching, because by God, if you're going to get their money, you're going to have them on the cap table. You're going to live with them. And there's a proper way to build a cap table if you had the luxury. How do you architect? How many shareholders should you have? Right? That's really important, because if you listen to entrepreneurs and again study history and hear entrepreneurs on the lessons of what not to do, you can hear how important it is to assemble a cap table of the right people. Don't take the wrong money. Oh my God, it can blow up your business. Okay, so this is all what I call investor relations. This is all the expertise we're bringing our clients. This is the level of coaching. It's not just the cadence and what goes into a monthly update. It's getting it right. Now, there's certain things you need to worry about at each stage, right? Stage of the business, stage of the maturity, stage of the funding cycle. You know, are you seed, A, B, whatever else, right? So that's the dynamics, and that's the stuff that we bring to our clients. I'm not here to sell Angelspan, so trust me. But these are important questions you're drawing out, and it's done properly. It's unbelievably elegant. If you looked at our testimonials, we've gotten testimonials that just prove the point. One of our clients got a testimonial, and he sent me the email. It says, Joe, I just raised $100,000 from a guy. Why? And he basically, the investor gave this huge quote, basically our output. He says, Joe, I can't tell you who the investor is because they didn't ask for permission, but he's the CEO of an internet company that just went public. Now, that's a pretty credible voice. A guy that's lived this journey, probably tried to produce this level of communication, but he never did himself, and he just went public. And if you saw the testimonial he provided, it was literally exactly what the promises that, or the claims I'm making, shall I say, on this call. If you get it right, it's elegant. You can attract a higher caliber investor quicker. One meeting, he saw them output, invested, and then he did invest in, the first check was 100,000. He ended up investing over three rounds, and it was $750,000. He invested properly as well. Didn't write the biggest check right up front.
How much work is required by the entrepreneur to comply with your system?
Yeah, well, we've worked very hard to be the smallest time burden on the CEO. Okay, the WeFunder folks is, what's the average time spent per month? I said, well, if the organization follows our coaching and our hand holding and our direction and our training, the CEO spends about 5-10 minutes at the end of the month. The direct reports, if they do use our platform right, or Slack, or hell, we even say you can email it to us, we don't care. But we want them just to weekly staff meeting, whatever you accomplish, jot it down, send it to Angelspan, whatever you're reporting that you accomplished to your colleagues, send it to us and go back to work now. That's it. How much time does that take? Depends on how organized they are as individuals in their own business unit they're responsible for. So it's hard to say, but we say done right, it can take as little as 15 minutes collectively of all the people providing us inputs. Now that is, they're humming. 30 minutes is probably on average. If it takes more than 30 minutes, then they're not listening on the training we give them. They're over baking it.
Got it. Great.
Yeah.
Well, I'm sold.
Well, just read the test. I just want people to talk to the clients, attend our office hours, hear directly from our clients. You know, yeah, we've been validated by multiple parties as best in class in this stuff. So what, right? We didn't pay for that. We didn't have some newspaper or magazine article make the claim. It's actually qualified people that come from the public markets and understand what proper IR actually looks like. But at the end of the day, it still comes down to a mindset shift. And I just call that professionalism. Adult behavior on the part of the investors in placing proper expectations on entrepreneurs, and then the entrepreneurs that want to actually be a professional entrepreneur and do it well, regardless of your business idea, regardless of where you're located, regardless of the optics of what you look like, what color, what gender, blah, blah, blah. These are things that are completely in your control. This is a huge opportunity for that overlooked entrepreneur to level up and be the adults in the room. And that's what we tend to attract, because they have a chip on their shoulder and they're willing to try harder. They're not trying to just be the loudest voice in the room to raise money. Anyway, I know I'm blathering on and on and on. We're past an hour here, Bonnie, so forgive my lectures. This is a small group. Any other questions or tactical stuff, or argue with me? Somebody call me an idiot and a pompous asshole.
Come on, Craig, you can do that.
It's all true. I'm not an idiot, but sometimes I get a little high-horsed on because I've just seen it and I'm just tired of the bad behavior. And I'm not very much a pragmatist. I'm a little bit more of an idealist or purist, if you will, but I've seen it work.
Nihal, Carrie, do you have any questions? Carrie, do you want to introduce yourself?
Sure. Hi, can you hear me or not?
Yeah.
Oh, okay. I'm sorry. I'm the new kid. Yeah, I'm Carrie Fox. My company is Stealth Pictures. I'm a creative producer. And I don't know, I've known Bonnie for a very, very long time. And we've talked about this side of the world off and on throughout, more and more actually, over the past few months. But so I've kind of begun to move towards, I guess.
Hold on 1/2 second. Bonnie, forgive me. I'm late. I'm checking my calendar and I'm late for a call here that I need to, I'm telling him right now, I'll be just another 5 minutes.
Okay. Oh, we usually go till 11.
Sorry. Oh, I did. That's.
Yeah.
I'll talk faster.
Yeah.
Anyway.
Hold on a second.
Okay.
Let me tell them I'll reschedule. This is just actually, it's a PR agency that wants our business. My apologies.
And Ian, I know you always have questions too.
Yeah. I don't want to cut this off. That was a vendor pitching me, but anyway, okay.
Oh, anyway, my model is kind of unlike, I think, most people in this room. My product tends to be entertainment. And so
What?
entertainment.
Oh, entertainment. Okay. Uh-huh.
More specifically, entertainment IP. And I'm, quickly kind of moving in the way I look at positioning this in the models to be more, I guess, investor driven. Because in one piece of IP in particular, it's actually, I've realized it's not one product line, it's a number of different revenue sources that can come from one idea. That said, do you find the need to kind of customize your model for different types of business models, such as mine? I mean, I'm not typical, I don't think.
I hear you can't believe how many times I hear, well, our business is a little bit different. If you want out money from somebody else,
yeah,
right? If you need external funding, then this model is relevant.
Mm-hmm.
Okay. Your product may be different than a software product or a tangible, consumer goods product, but you still have a product. Years ago, when I managed money, there was an accountant that was the CPA for one of my clients, and he did contract controller work on movie sets, movie production. So he was a guy that literally would pay the vendors, and that was a side gig he had. And this guy was an accountant in LA. And he said, movies are just like a startup. Everything is very, very similar, right? So even entertainment product is similar. If you've got IP, that's your balance sheet asset. That's your product you're going to monetize through multiple channels. That's no different than any other product. So to answer your question, no, it's not. This is relevant for the Bell Mason is relevant regardless of the business model, if that business wants to scale by seeking outside capital from some strangers.
Right. Okay, I'll go do a little research on Bell Mason. It sounds very interesting, however.
It works. Yes, we've had movie studios, production studios as clients, by the way.
Oh, great.
Using Angelspan. You could talk to them if you cared to. But yeah, no, they did. They actually, their business model pivoted to well, I'll let you talk to them. But anyway, so yeah, we've been able to do it around a production business model.
Well, that's great. Yeah, definitely.
Production.
Okay. Thank you.
Joe, I mentioned in the chat, there's a VC firm that I know in Toronto that seems to use a model that it sounds a lot like yours, but they use it for their own, investments. I don't know if you've heard of them. A Loyal VC.
I do know Loyal. Yes, I do know Loyal. They don't use the Bell Mason. Loyal is about the diversification in their venture model itself. Yes, they have their own internal scoring. It might be Bell Mason. They might have modeled it after that. The I-Core curriculum that Steve Blank teaches entrepreneurs is the Bell Mason diagnostic. So the ubiquitousness of this model, those 4 areas and the relevancy of it and the stage, what are the milestones across the different stages of the build out of the business? That's a well-founded concept, versions of which is because the Bell Mason's been around for a fair amount of time. Said Steve Blank was involved and he was involved in its original pull it together, and then he took it off and made it the I-Core curriculum. The Lean Startup Canvas came right out of the Bell Mason diagnostic and the milestones around finding product market fit. But that's just a small window in time from a life cycle stage, and also just those areas, those milestones around product and market, not team and operations. Okay, so yeah, it's been around a long time. It's every accelerator should have been teaching this curriculum, but they had to create their own secret sauce because they're branded and we're Techstars or we're whoever, so they had to have some secret sauce. When in fact they're recreating a wheel that was already scientifically built and has been applied elsewhere for a long time. Corporate VCs have used the Bell Mason for almost 30 years as their due diligence criteria and post-investment monitoring framework.
Okay, thanks.
Michal, did you have any questions, or did you want to say anything? Or
no, actually, don't really have any questions.
Or even a comment.
It's a lot. I know it's a lot.
Yeah, just digesting everything.
It's not as hard as it sounds, and getting over the fears. I think it was Joseph was asking, what's the pushback? And from entrepreneurs, it's fear. And we just say, look, it's month to month. You can fire us anytime, but let us get the first one out. Let us get that first update out, because they get such a resounding feedback. We got them hooked. We get tons of immediate, literally validation And we've had lots of testimonies, lots of situations where the first update triggered investment, even from investors that the CEO never pitched. That shocked me. But this was like sort of high profile technology, cybersecurity, where the chief technologist had a fancy resume. The daughter was the CEO, and had great investors on the cap table already. And two of those investors knew about what we're doing and said, you got to go use Angelspan. And this gal, she was just this hard-headed thing that she thought she could pitch better, and struggled. And they kept banging her over the head, use Angelspan. After about a year, she finally did. First monthly update went out. An investor sent in $200,000. She never pitched because they had already been tracking the business through these high-profile investors and through the other stakeholders. One of her stakeholders sent that update to this investor, and they literally invested $200,000. She never even pitched them. Okay, so this is the sort of stuff we've just seen time and time again, which is completely logical. But entrepreneurs themselves that don't know what they don't know, it's fear. And we just say, look, it's month to month, get the first one out. And we coach them what a stakeholder is, how to, what, all that sort of stuff. But it just works. And it's a powerful control mechanism for the bullshitters. People say, is this audited? And the answer is A, it doesn't even matter if you're audited financials. Bad apples are going to find out they're not even audited financials as a public company, like Silicon Valley Bank. But there is actually part of the research, if you understand this, some of the other research is by having it go through a third party like us that's going to hold them accountable to specific topics and specific areas. It's literally an organic audit process, because they have to, by reporting sequentially over time, we can always catch them in a lie because they're reporting to us what they accomplished, and we're scoring them against the Bell Mason. And so all of a sudden, if they're making a claim that really wasn't true, and then later on they make the claim again, so wait a second here, right? They're literally, and we've had that happen. We'll take points away. We'll literally reduce their score. So there's because it's an ongoing process, there's sort of an implied audit that takes place that, and if it's a real bullshitter, they won't hire us or they won't use us for very long. They'll try and figure out how to do it and what are the topics, and then go back and do it themselves. We've tracked those that used us and failed and then left us, and the failure rates are the roof, right? Because they think they can do it themselves, but they're going to pay us for a couple months to teach them. That's a bad psychology of a CEO. Are you kidding me? Go build your business. Right.
That goes back to that micromanaging. Like
exactly right.
Yeah, that's the same
exactly
mentality.
Right, it just is, for groups like Bonnie and others that help entrepreneurs, we're trying to educate them. Maybe Joseph, this is, you and I may even have this conversation. You should make this a filter for who you even accept as a client. We've got venture studios baking in the application process for the same reason. It's going to elevate the quality that you let into your tent, whatever form that tent might be. If you're providing capital, either human capital in the form of mentoring and advice, or financial capital, or in venture studios, some or accelerators, some combination of the two, you should care about who you let in the door, because they can be a massive time sink. They may not be coachable. It may be a shiny object and they may have a fancy background, but it could be a waste of everybody's time and money.
By the way, if a CEO is worrying about $250 a month for reporting, it's not a business you want to be working with anyway.
Thank you. It's a powerful due diligence filter, unbelievably powerful. People talk about managing their funnel. This is an unbelievably good. We've already seen it.
Oh, by the way, David has a question.
Yeah, go ahead. I'm sorry. Yes, sir.
Let's see. Ian is launching his virtual film school. My project is launching as soon as one more software thing is uploaded. So non-revenue, should we sign up for pre-revenue?
Yeah, the right time to sign up for us is 3 months before you want to raise money from strangers. The first time. And then you keep us through all following rounds, of course, but the first time, how early you should start is 3 months before you're trying to raise money from strangers. And that can't be 50 grand here or 50 grand there from strangers. I'm talking about a decent chunk of money to build the business. So you burn through your friends and family, your bootstrapping money, you feel like you got enough meat on the bone to go out and pitch to strangers. That's 3 months before, because the archive of prior updates, we're starting to create a motion picture of your operating momentum. By having sequential monthly updates, pictures start form on your momentum.
So you've just replied along a different dimension than the one I asked about, which was revenue. So you're saying 3 months before outreach to investors, but how would revenue drop into initiation of revenue fit into that time?
It's just a stage of your business.
It just shows up in the monthly reports. And yeah.
Oh yeah.
Mhm.
Yeah, the Bell Mason.
Okay, so
I keep coming back to Bell Mason. It's the construct of what is a natural thing to expect from investors given the stage of your business. And expecting revenue at the seed stage is a false expectation from uninformed investors, inexperienced investors, right? You got to build. It's like, use the real estate analogy. If you only reported once you started getting revenue, if you're a builder of a building, holy crap, it's a finished product before you can create revenue. But doesn't mean you're not spending investors' money to build value as you're building this thing to get ready to monetize it in the form of rents.
got it.
Business the same way. These are arbitrary hurdles to think I don't have anything to report on. You're building value across those dimensions. The Bell Mason allows us a construct to be able to communicate it. You don't need to worry about communicating until you're 3 months before you're going to start raising money from strangers.
So the track record, regardless of the revenue stage.
Exactly. You're building balance sheet assets.
Thank you.
If you really look at what these earliest stages are, when you're spending your money, your bootstrap, your family, friends and family money, you're building balance sheet assets. And that they're in accounting terms, they're called intangible assets. It's not like you're building a building. You're building domain knowledge, industry knowledge, market presence, market awareness, maybe the IP itself. And then the product itself, you may start building. And the product may be design-based, not some technology program-based. Just depends on the industry, right? So yeah, that's the, sorry, Bonnie should have warned you, I'm a financial nerd, but I put a lot of things in financial terms. But that relationship between entrepreneurs communicating in a way that could optimize on getting the resources you need, that's what we do this for. These are some of the common questions and things that are, because most entrepreneurs don't understand financial statements, basic financial statements, and what is on a balance sheet, much less what an intangible asset is and the power of it. The largest asset on most corporations is intangible assets, public companies, because tangible assets get depreciated, they wear out. But intangible assets, Coca-Cola, if you look at their balance sheet, their largest asset is goodwill, brand value. The secret sauce of their original Coca-Cola, it's horseshit. Brand value. And they spend a ton of money perpetuating that brand because it's their largest single asset, as they should. So the Bell Mason allows us to take and give your readers confidence that there's actual value creation taking place, even though it's not tangible to the visible eye in the form of revenue or the usual KPIs that they heard at the last Angel Group meeting.
Well, that's what a lot of investors have been saying lately now, traction and revenue. Like now they want to see revenue, but the big talking point.
They're just, because they don't know any better. They should buy low and sell high. I can guarantee you that will work as from an investor's perspective. The problem is most of them don't know what low is or high is, right? And we help communicate that. What's a good valuation for a seed stage startup that's got the level of traction and the velocity of traction for a seed stage company in that industry? We can communicate that. Say, this is a great deal for a seed stage company. It has nothing to do with revenue. Okay. That's how investors should think. They should also want to buy low and sell high, not buy high and hope to God sell higher. That's called the greater fool theory or a Ponzi scheme. Chamath has said the venture industry is a Ponzi scheme. It's hard to argue against that from a structural standpoint. The venture industry. Now, there are good VCs. We're talking about generalities, bell curves. You know what I'm talking about, right? There's really bad apples and there are really good VCs. We're talking about the generalities. Anyway, Bonnie, you probably never have me back now. I'm getting.
That's not true. Of course I will.
Getting pompous.
I have one more question, but it's a little bit of a digression. There was a fund set up a few years ago to invest in young people who had never been to college, and it was announced there was $100K to get started. What's your reaction to that?
It was TLU, by the way.
Yeah, it's Peter Thiel. I love the concept, because part of that was Peter Thiel poking higher education. He said if you follow him and understand his sort of his MO or DNA or whatever else, I understood that they have the Thiel fellowships, etc. I don't think it's a bad idea. But it's a commentary on higher education largely.
But I did want to comment that one of the founders who did get the 100K was Vitaly Buterin. I know
There you go.
the founder of Ethereum.
Yeah.
Yeah.
For their really bright young people, I understand those constraints. Not that that was ever me, trust me, but I do understand the constraints of the current higher education path. Even at Stanford, unless you're a deep scientist, MIT, it's real weird technical stuff, right? MIT does crazy stuff. I think it's not, the ROI is not there. There's actually a new university that's trying to change the higher education called University of Austin that's going in. I'm actually involved in it. It'll be an adjunct. They're trying to have the rigors of University of Chicago with the embracing sort of innovation and entrepreneurship like Stanford. So they're going to be across the University of Chicago and Stanford. But they're doing it completely outside the existing higher education model. They're changing everything. They're approaching it to fix higher education, not just be an incremental university. So like I said, and I know some of the PayPal mafia are donors and supporters of the University of Austin, including Joe Lonsdale wrote the first big check of $10 million, and he was an intern at PayPal when he was at Stanford. Then he helped with Peter Thiel, co-founded Palantir. So yeah, you'll probably see Peter Thiel involved in the University of Austin at some point. But I think that was a logical reaction to what's wrong with higher education, which he's spoken about at length. Even Stanford. Hope there's not some recent Stanford grads on here. It looks like anybody, but Nahal, you're the most recent college grad potentially. So hope you didn't go to Stanford.
No.
Now Stanford was, and they're still obviously like any university, great content. Again, we're generalizing. But the ROI is hard to rationalize given the cost escalation of higher education.
That's for sure. Any last questions or comments, or if anybody would like to say something besides Joe, although we're always happy to hear from you too, Joe. Not a problem.
I'd just like to say thank you, Joe. This is really quite in contrast to many investment experience narratives, and it seems really intensely valuable. So thank you.
I'm glad it was valuable. It wasn't just a pompous guy that feels like it's about time people cared about risk management and adult behavior. That's sort of my attitude right now. But it's it's research based, it's logic, it's common sense. And yes, it runs counter to what's oftentimes promoted or taught to entrepreneurs. So
thank you all for joining today too.
So Joe, any last pearls of wisdom?
My heart has always been for the entrepreneur. They're the hero in American capitalism, is the entrepreneur, the authentic entrepreneur. It is the Joseph Campbell-esque hero's journey.
Yeah.
It's not a guarantee. But what you can guarantee is your personal brand, that you will be worthy of a follow-on investing should the startup you're working on fail. It's how you comport yourself, the choices you choose to make in your attempt. Gene Kleiner of Kleiner Perkins said, I won't invest in an entrepreneur that hasn't failed before. So failure doesn't kick you out of the entrepreneurial gene pool. How you behaved does. And this is something that's entirely in your control. You can't control what the marketplace is what's going to happen in the banking. Is there going to be a pandemic? These externalities. But you can control what you do and how rigorous and how thoughtful and how tenacious you do it as you're building your business to pursue your passion, your dream, that otherwise unmet need in the marketplace. Otherwise, why do you exist? It's a lifestyle business. I take that very, very seriously. And I've seen unbelievably honorable entrepreneurs that can't get an audience while idiots get funded. And that's, to me, the crime that has kept us so motivated off and on for 20 years. The first time I tried to solve this was a predecessor company 22 years ago called Angel Legacy, to bring professionalism in how we fund startups. First cap table management, first portfolio reporting, first IR, third funding portal on the internet. This is back in 2000 we launched it. That was all one company to bring that level of process, toolkit, and rigor to both parties, how they come together and how they behave with each other. So I deeply care about the entrepreneur, because that is ultimately unfortunately in the current narrative, the VC's the hero. The LPs are just the, patronized raw material of capital, and the entrepreneur is the tool for the VCs to make money and be celebrated as a rock star. That's completely upside down. The VCs is last. The entrepreneur is first. The investors willing to provide that capital are second. The VC should be third, but that's not the system we have today. And that's what needs fixing. And that's what we're 22 years and counting. And I think we're going to get there now. So.
Well, thank you so much. We really appreciate this.
Yes, one man's opinion.
Yeah,